Hey everyone, me Kevin here. Boy oh boy, I have figured out who is capitulating. In this video, we're going to talk about exactly what the heck is going on, who's selling, who's using margin. We're also going to get a bit more color from the Fed, which adds to the video that we talked about yesterday, new information from this morning. We'll talk Walmart, we'll talk Target, we'll also talk about some moronic statements from Home Depot, like absolutely ridiculous. You're going to laugh over this one. All of this while Tesla was just kicked out of the S&P 500's ESG index, which is just like, do you need any more evidence that it's rigged when Tesla's like the leader in environmental efforts? Of course, they're complaining, but Teslas have crashes and then their battery fires and stuff. And, their corporate governance isn't great for work-life balance or what. Jeez, oh my gosh. It's rigged. Anyway, but first, I have to really quickly apologize. So, we have a really large announcement that we're working really hard on coming within the next 30 days. It's that Series A that we've been talking about. If you haven't put your info yet, metkevin.com/Series A. Those anybody who puts their email there will be second in line. Course members first for the Series A launch. So that'll be really exciting. But I said I have to apologize. I have to apologize because we've been so freaking buried with like a pitch deck and attorneys and all this crazy stuff. We are just logistically so buried. And I've got so many emails from people that are like, please, help us get an answer on which bundle to get, or can you extend it a few days? I'm getting paid in a little bit. So what we're going to do, long story short, is we're going to extend the coupon code for the programs before we have that largest price increase ever. Sorry about that. To the end of the month, it's just going to be easier logistically because then we'll be done with the attorneys and all our paperwork and everything, and we can just go into June all set. So I just want to apologize. It's my fault. If I had more staff, it would be easier. But don't worry, we will get that solved. Okay, so now I want to talk about kind of what's going on in the market because it's a mess, and then we'll talk about the other things I alluded to. So first, look, yesterday I made this analogy that it's kind of like we're on this wave runner, right? I think the easiest, I'm kind of adapting that analogy a little bit. They got wave runners down there, by the way. I'm changing the analogy just slightly. I kind of think that in this market, you almost want to be like a volatility trader. I'm not, but, some people are. You almost kind of want to be a volatility trader where, like, you're on the wave runner, and sometimes you go, oh, you get hit and it hurts, but at least you're kind of moving around and dodging the waves as you can. But if you're a hodler, just to give you a feeling as to what it's like, imagine you've got a volatility trader driving your wave runner and you're bobbing around all the waves and you're holding onto the back of it and you're just getting your face slapped and pummeled in the water as all this stuff is happening and like your legs are flailing everywhere. That's kind of what it feels like to be a hodler right now. One day Tesla's up 5%, the next day it's down 5%, down 5%, down 5%, up 5%. It's a disaster, right? So if you're a hodler, it's a hard time. And so a lot of people are actually starting to capitulate because of this, because it's a very hard time. And so I want to talk about who's capitulating. First of all, if we look at retail, you've got retail still buying about $1.1 billion per day. Now, that's pretty consistent with the daily buy volumes that we've had really for the last year. So you haven't seen much of a change there, no huge decline or increase. So retail is still buying together. But there's a massive difference in how people are buying. So retail, younger retail buyers continue to use margin to buy the dip, especially folks over at Schwab. They're noticing that margin account balances are going up while actual net account balances are going down. That's because the market's going down and people are using margin to buy more stuff. Now, this is a sign that potentially younger, more aggressive retail investors are trying to make up for prior losses by either using more risky option trades or by just going into margin to try to hopefully amplify their gains on the upside and make up some of the prior losses. Now, this is the complete opposite of apparently what's been happening to older retail. Older retail and wealthier retail, they tend to use mutual funds, and we're seeing net retail selling in mutual funds. And so this is quite interesting because it reminds me of my family in 2008 when they're like, oh my gosh, our 401ks are getting decimated. Let's sell everything. I'm like thinking to myself, dude, that was like the worst possible time to sell. And so it's kind of interesting that right now you've got younger retail being, in my opinion, stupid by using margin. You should not use margin to buy this stuff. Have patience. 2022, it's going to be a long year. Don't use margin. Have patience. But buying, I like. I think that's a good idea. I think selling by wealthier and older individuals to reduce their exposure to equities, I think is stupid. I think it's also stupid. So I think everybody's stupid. How about that? No, I don't really think that. But in terms of flows, it's worth noting that AMD seems to be having the most retail outflows, whereas Apple seems to be having the most retail inflows, followed by Tesla, Nvidia, Microsoft, Amazon, and then Google, Facebook, Netflix, Baba, and Neo, sort of in those groups there. Now, regarding recession, the suits seem to think, some of them seem to think it's already priced in. Some of them think there's only about a 44% chance of a recession in the next 12 months. Others are starting to get upside hedges. I like seeing kind of what the suits start saying and what they start doing. And when they start getting upside hedges, I start getting a little bit excited. No guarantees. I mean, obviously, the Nasdaq's down like 3.2% of the time of this recording, but that's a way of preventing FOMO. And I actually think it's a really good strategy. Now, it might cost you a lot of money, and it's worth noting that. And there are ways you can minimize that. For example, if you buy upside calls, you could also like sell some puts or sell some calls. But and then that way you're paying a little bit less of a debit, right? So the big thing, though, is when people get upside hedges, I actually think it's very smart because usually upside hedges are designed to prevent you from taking on excessive risk when there's still downside potentially left in the market. So, for example, you get some out-of-the-money call options where you're like, it's okay if this goes to zero. I just don't want to have FOMO if the market runs. The reason you do that is to prevent you from going like all in on margin and then the market plummets a lot more. Because you go all in on margin and then the market plummets, you get liquidated, now you go bankrupt. You have an upside call and the market plummets, you lose the premium you paid. Okay, big deal. That's better than going bankrupt and getting liquidated, right? It's the same. It's like, but if the market runs, you'd make a lot of money being all in on stocks and margin, but you'd actually make potentially the same amount of money with your upside calls. So it's just a safer strategy if you are trying to prevent FOMO to have some out of the money upside calls. Just know volatility is very high, so you're probably going to get vol crushed as well. So it is a risky game to play. So, sell some calls and puts to kind of offset that a little bit. Now, it's also worth noting that, remember that a bear market and a recession are different. In 1987, we had a stock crash nicknamed Black Monday, and we did not have a recession. Just like in 1990, we had a recession caused by an oil price spike, but we did not actually have a stock crash. So if you think about it, just because we might be in a recession now, or we might be heading into a recession, recessions do not necessarily have to correlate with stock performance, especially if those recessions are caused by things like trade deficits or wholesale inventories or things that are really disconnected from the consumer. So keep that in mind. We're pretty much, right now we've seen a sell-off that's much more similar to 1973 and 1975. Personally, I think that's a substantial oversell. I think the market is quite oversold because I think the market believes that there's no way inflation is going to go down, and they're winning the battle right now. Personally, the reason I'm buying stocks is because I believe that inflation will go down. So you kind of have to make that expectation, right? Remember, if you think that we need to get Paul Volckered, like I said in January, you should not be in the stock market. If you think the Fed's going to Paul Volcker us, get the hell out of the stock market. Charles Evans actually gave us a little bit of clarity this morning. So yesterday we talked about how high I think the Federal Reserve is going to go in terms of above the neutral rate and what the market was expecting. So Mr. Evans, he's the president of the Chicago Fed. He thinks that the neutral rate is somewhere between 2.25 and 2.5. And he thinks there's a chance we might have to go 0.5 to 0.75% above neutral to really be restrictive for a long enough period to get inflation down. That kind of implies going to about 2.75 to 3% at the Fed funds rate. That's roughly already priced in. The odds of sitting at 2.75, I believe, were about 36%, and 3% were about 44%. So the market's kind of already expecting that. This is good because when the market already has that scenario priced in, it means even when we get to that 2.75 or 3%, we've already seen damage in the market. Now, we've got to talk about some of these crazy, crazy consumer numbers that came in this morning and the insanity, the absolute insanity of the Home Depot report. Like, you will not believe this. But before I tell you this, we got to get to a quick message from our sponsor for today's video. No, not the courses link down below. Titan. Let's go.
But first, I want to thank today's sponsor, Titan. Guys, the stock market is all over the place. From the S&P dropping almost 13% from January to April to Elon Musk trying to buy Twitter. There's a lot to consider when investing right now, and that's where Titan comes in. Titan is the first investment app that gives everyday investors access to an award-winning investment team who strategically manages your money. Titan's team of experts actively monitor macro trends, world events, financial patterns, and rigorously evaluate investment options to optimize portfolio portfolios. Things that I know from personal experience that honestly take several hours a day. It's quite a lot of stress as well. Titan will send you updates about decisions made with your money, and you can even ask your team questions to learn more within the app. And it only takes $100 to get started. Deposit your money, select your portfolio, and Titan's team of analysts will allocate your money for you. And for a limited time, if you use my URL, which is linked in the description down below, titan.com/Kevin, you'll get $50 for free, plus your first 3 months of active management for 0 fees. That's titan.com/Kevin. Deposit at least $100, and they'll give you $50 and 0 fees. Check it out. Link down below.
All right, thank you, Titan. So now let's talk about this, okay? Target, complete disaster. So comp sales actually beat 3.3% versus 1.17. That's great. Top line beat. But what happened to the bottom line? Well, the bottom line was a disaster. EBITDA came in at just over $2 billion. The expectation was $2.2 billion. Operating margin is forecast to be just 6% versus over 8% expected. We missed on adjusted EPS, and the stock has had the worst decline of over 20% that we've seen since 1987 in the Black Monday crash. The executives say that their margin is being hurt by actions to reduce excess inventory. Folks, that's Cathie Woodian right there. When you start seeing companies that are like, okay, we have excess inventory that we got to dump, that's Cathie Woodian. Remember what she says. She says, hey, companies are going to see that supply chains and freight are going to ease, and then they're going to end up having over-ordered, and then they're going to have to dump this stuff. They're going to have too much stuff. And so that's what we're seeing here. In addition to seeing over and excess inventory, they're still seeing higher freight and transportation costs. And they say, quote, many of these costs will persist. That's like the worst thing you could say is that P word for the Federal Reserve, by the way. They also noticed a, quote, dramatic change in sales mix in Q1 to lower margin items. They see people spending less money on, listen to this, apparel, home, and hardline goods. Geez, man, what have I been saying since January? I've literally been saying it since January. We're going to see people spend less money on stuff like Nike, Under Armour, clothing, and all that kind of stuff, even household goods. Why? Because the lower demographics get hit the worst when we have inflation. People making under $100,000 a year as a household income are going to spend less on clothing and the like. This is why I have always felt that Tesla is slightly more insulated, because you actually appeal to a higher income demographic around that $140,000 range. Those individuals, some people speculate, will also cut back. But that's not what we're seeing. It's literally also what Target is saying. Target is literally saying that we're still seeing higher end goods sell really well, like gaming consoles. But at the same time, you're seeing the lower income demographics spend more money on private label goods rather than brand labels. So in other words, store labels or private labels versus brand labels. This stands in contrast to what Procter & Gamble said in Q1. Procter & Gamble said, hey, we're still seeing people go for the brand names like Gillette or this, that, or whatever. But no, this is a red flag for Procter & Gamble if you're in it. Target and Walmart, both of them are saying, no, people are starting to shift to cheaper stuff, and they're also shifting from goods to experiences, which is obviously outside of Target. They're also seeing a reduction in big and bulky goods, which would be like furniture, beds, gazebos, whatever. Walmart had a very similarly embarrassing, and I use the word embarrassing because that's literally what they described it themselves on purpose, and they complained about the first quarter being a disappointment, being embarrassing, that labor and fuel costs spiked, that inventories also ate into profits. Listen to that. Now, obviously, you had three major issues by them. One was expenses, number two was inventory, and then number three was the same thing that Target saw, freight and fuel costs. They also mentioned that what people are spending per cart is up, like think shopping cart, but the number of items they're buying is lower, and they're seeing a, quote, shift away from discretionary, more into food and consumables, and wow, surprise, surprise, same thing as Target. Less apparel, less patio, less landscaping stuff. Look at that. Starting to see those cracks and people actually trying to spend on having their homes nice. This makes sense, folks. This is literally playbook what happens with inflation. People stop spending money on stuff. Except the richer people who can continue to sustain until they can't. You know, at some point, if a recession lasts long enough, wealthier people stop spending money as well, too, or they start tightening their belts. So we'll see. Now, Home Depot. All right. This was an interesting one, okay? This was ridiculous. So first of all, I just want to finish there on Target and Walmart. This is not a surprise. These are your lower end consumers that are getting whacked. We expected this to happen. It's literally what's happening. I think the same thing's going to happen with Nike, Under Armour, Lululemon, you name it. Consumer discretionaries, we already know that e-commerce consumer discretionaries are untouchable. There's a reason I have stopped using them. Also, I was asked yesterday, we did a course member meetup here in Miami yesterday. It's really cool. I posted a picture of it on my Instagram story. A lot of you came out. I was really surprised how many of you came out. It was really cool. But one of you asked, and I thought it was a great question. You asked, hey, well, what about a firm? You had mentioned that in the earnings call, they say that the usage of a firm actually goes up in a recession. And I'm like, yeah, I thought about that a little bit. It's true. Usage goes up during a recession, but maybe that was only during the 2020 recession. See, that's when a firm's been around, was during the 2020 recession. And maybe usage went up because people knew they were going to get their stimmy checks or their unemployment checks. So they're like, oh, I'll just use a firm now and pay it off later, right? Buy now, pay later. But what if this recession is different? What if this recession lasts substantially longer? And people are like, I'm not going to be getting a stimmy check to pay this debt off. Let me just not buy in the first place. So I'm a little skeptical because of that. And remember, for me, as much as I like a firm and their business model and their partnerships, and I think they're great, I can't hold them in a recession, because what happens if this recession lasts for another 6 months? Well, if this keeps going for another 6 months, or it keeps going for another year or two, what happens, folks? Well, what happens is people stop paying. And what's the recourse for something you bought on a firm and then you don't make a payment? Nothing. I mean, maybe they'll hit your credit, but if you're filing for bankruptcy anyway, your credit's going to be screwed anyway. It's not like they're going to come to your house and pick up the Peloton bike you bought. Like, they have no recourse. They can't take your plane ticket away from you that you already flew on, So what they do is they hit your credit, and then they kick you out of the program. Well, in a recession, if people are going BK anyway, who cares? Oh, wow, I can't use a firm anymore. Oh, well, you can't even take the stuff away I bought. It's like... it's not something I could be in a recession. Anyway, then we get to Home Depot, folks. This was a disaster, okay? Home Depot, they were bragging about how good their report was, but I read the earnings call, and I'm like, y'all are dumb. They're like, oh, well, 90% of our do-it-yourself customers are homeowners, and most of our pro customers, like contractors, work on behalf of homeowners. Okay, well, that's no surprise to me. But then they're talking about, hey, a lot of our homeowners have fixed-rate mortgages, and only like 4 to 5% of homes sell a year. So we're not really worried about Home Depot sales being affected by the real estate market, even though people have more equity than ever before, and people are feeling so happy about their equity in their homes right now that they're spending more on their homes. I'm like, geez, Home Depot, you don't realize what you said. They literally do not realize what they just said. They literally just said, hey, we are really, really exposed to people's home equity going down. Well, what do I think is going to happen in the real estate market? I think equity values are going to go down. Prices are going to go down. It's going to take a while. It's going to take 6 to 12 months for comps to actually hit. First, we got to get to neutral levels of inventory. Then we got to get to excess levels of inventory. And then we're actually going to see pricing potentially go down. If we do see that pricing go down, Home Depot is going to be at risk. They're literally telling you, oh, yeah, prices keep going up so much. That's how we continue to, have more sales over at Home Depot and how we have such strong demand. Okay, great. Well, what happens when Tucker Carlson starts talking about prices going down and home equity evaporating? Guess what happens then? People ain't that happy anymore to go spend in Home Depot. It was really moronic that they're so blind to that. And I honestly feel like people on Wall Street just do not understand real estate. And I'm not trying to pat myself on the back here, but I'm a ground up kind of real estate person. I didn't go to some ivory tower to learn about real estate. I learned real estate selling Quonset huts and selling the bottom end stuff that exists to finally move up to expensive real estate. I've sold every level of real estate that exists and every type of real estate I've worked with, industrial, commercial, you name it. Real estate is something I really feel confident about, and I'll always feel that way. But anyway, I guess we'll see. Okay, good. So we talked about Evans. Yeah, wow. Okay, very, very, I think, thorough update. That's everything I got for you. Thanks so much for watching. Check out that coupon code. Yes, it's extended. I apologize for that. It's my fault. Email me if you need help with those bundles. Okay? You could bundle up. You get a special deal. Email me, kevin@meetkevin.com. But give me time to reply, like 48 hours. Thanks so much.